Good morning, everybody. Thrilled to be here to talk to all of you. A big piece of our role is just trying to figure out how do we reduce severity. And in that regard, we spend a lot of time, my team spends a lot of time working on analytics around servicing policy, like what are the best sort of loss-mit options we have available in terms of modification programs, through into how do we reduce costs and timelines within REO, distressed collateral liquidation, a lot of work on servicing performance, and a lot of work on sort of like portfolio management and with portfolio strategy. Today, I'm going to focus on sort of what's front and center in our mind, which is all about the sort of COVID crisis, and really trying to walk through sort of three big key areas of this, which is what we know, what we've seen and heard, and I guess predominantly anecdotes, and obviously every day new information becomes available to us. And then finally, sort of what we don't know, with a little sort of tie back to how we're thinking about it and what we're trying to do about it. So actually, if you could just go to the next slide, please, I'll get stuck into this first batch. With the CARES Act sort of spooling up in mid-March and this access to, for all intents and purposes, a risk-free forbearance, there was a substantial surge in people requesting it, so much so that servicing call centers were rapidly overwhelmed, and a huge sort of push was put in place for some kind of online portal or technology to help capture what was going on. At that time, what we had seen and what we have still continued to see was that a huge percentage of the people calling in for help were still current on their mortgage or had already made their March payments, and were sort of looking for what might happen in April or what might happen in May. We've seen that, borrowers put on in March and April have made one or two payments. We've also seen borrowers who went delinquent but were able to make a payment. And so there's this interesting dynamic and concept that it doesn't appear happened during the Great Recession of the financial crisis, but it's happening now with a lot more of the social media attention, and here's what's sort of readily available to you. It's a very different sort of borrower dynamic, and also with the servicers and the technology they're able to roll out and the pace that they're able to roll out, a very different servicing experience. There's a lot less friction in the process now than there ever has been in the past. And the concept of putting people on forbearance quickly and getting modifications done quickly, servicers have had a decade to really get stuck into this, and they've got a lot of experience. No one saw this coming, but the good news is on a couple of fronts. One, our portfolio is in really good shape in terms of the credit quality, but separately, the servicers have had a lot of time and experience to design, build, and kind of manage out their platform. I do want to point out in this that there is a lot of sort of attention on this like 6.5 or 6 to 6.5% forbearance. The technical term for forbearance is they're only on forbearance once they've missed a payment. And so that's important. It's important because we saw this huge surge in forbearance plan starts, but we did not see, and we also saw a similar surge in delinquencies, but we did not see the delinquencies stack up to the forbearance plan start that we were finding. And so that's where we kind of move on to these last few points here where we talk about the total delinquency rate was about 4.25%. Now, mind you, it was at about 2%, or 1.8 prior to the COVID crisis. So that then, and with a 5 or 6% forbearance, shows that at least in April, about half of the borrowers went on forbearance and continued to pay. And then we saw in May that kind of persisted, and up to about a third of borrowers continued to pay on their mortgage, which is really fascinating. So as we kind of move down to this concept of unemployment versus income, unemployment matters, but the real driver is income loss. And so what's interesting in this space is with the onset of like the government programs and the unemployment insurance and this additional income rolling in, while we still saw the delinquency spike, we think that there's been moderation because there has been income that has come in to help make up. And we've also seen and heard that the income in some cases is more than the folks were making prior. And so it's going to be interesting to see sort of what then rolls through in this post-July space, and if there's other changes in how the timing works with the reopening of the economy. And just to reiterate this last point, the portfolio we have today is in substantially better shape than it was in the crisis leading up to 2008. And, as of December 31st in our 10K, the filing, the LTV is somewhere around 59% with a FICO of about 750. So even if you assume that there is some house price decline over the coming couple of years, and understanding the timelines with the foreclosure moratoriums that we have in place, a lot of things have been put on pause, both leading up to foreclosure and also once you're getting into REO, that if those moratoriums sort of unwind, what we have seen in the past, and I don't know if what we see now is going to be like what we've seen in the past, is once the moratorium unwinds, there is a surge in pent-up foreclosures that are just ready to go, that then happen very, very quickly. We've seen that a couple of times, one with the natural disasters back in 2017, and similar with the foreclosure moratorium put on during the Great Recession as part of the robo-signing. In the month or two following, rapid increase in foreclosures, helping to get things back on track. Whether or not this is the same as before, I don't know, purely because a lot of it will be based off of how comfortable are people going out into the courthouse, into ballrooms. Online auctions at foreclosures are still pretty rare. You sort of have to be in the county with the money on the day, unlike in REO where you have the ability to sort of buy from anywhere in the country and frankly, globally. This is just to give you sort of like a visual representation of what I'd spoken about before. You see this rapid spike in D30 rates from March leading up into April. You can then see that a bunch of those roll off from April into May as a D60, but the actual share of 30s goes down. So we are having more inflows into 30, but it's not as fast as the rollouts into 60. Back to sort of like the anecdotes. I've covered many of these points, but I do want to point out a few other things. We have also heard that borrowers have called in just asking for information about what forbearance is, only to find out they've been put on a plan unexpectedly that they didn't want. And then they call back in to say, I need to cancel. And so we see some percentage, and again, anecdotally, somewhere around the 5 to 10% range, depending on which servicer you talk to, as to what level people want to unwind their forbearance. So they didn't really realize what it meant or what the potential impacts could be. Until the refi sort of change in policies came out, people were like, well, I want to refi, but now I can't because I'm on a plan. How do I unwind that? So we're beginning to see people calling in and having them canceled or hearing. We've also heard that a lot of borrowers are just doing that as an insurance policy. So well, what does that mean? It means, well, look, I don't know what's going to happen in the next couple of months, so just give me the option that I don't have to call you again because I've already been on hold for such a long period of time. I'm not quite ready for this, but I might be in a month or two. So let me just have it set up so that when I stop making payments, it's all good. Strategic forbearance. People who are financially savvy are looking at this and saying, hey, you know what? I have an opportunity here to really take, up to 12 months, somewhat risk-free, balloon it at the end, and I can take that money and I can put it somewhere. I don't know how many of these we are getting. We will do research in this space over the coming months as we get a better feel for it. These guys, though, if they really are strategic and they aren't really badly impacted, the loss, which is the big thing we really care about, the loss from this group will not be substantial, right? Because they should just roll current at the end of it, and everyone's fine. They have the ability to pay. They are just unwilling. And so it's the ability and the willingness which really, really matters for a, quote, strategic forbearer in this case. Very similar to a strategic defaulter, but with the defaulters, they actually caused losses, and the forbearances we may not see. And I touched briefly on this last bullet point around unemployment and, how the benefits, because they're outweighing what people were making, assuming that these are the people who own houses as well. These are all big assumptions we're trying to lump into here. That it could lower the short-term rates, but as these processes expire, does that create issues for people going back to work because they don't want to? Does it slow things down for bringing the economy back? As people are like, well, I don't want to let you back into the building to do the work because you're getting paid more at home. Or is there another resurgence of re-employment in August? So all sorts of, again, seeing and hearing on the anecdotal side. Right. So this is the big one. These are all what we don't know. And I do want to reiterate again that the portfolio is in really good shape in terms of credit quality and in terms of LTV than it was leading up to the financial crisis. So depending on timing and how long things take to get, quote, back to normal and when the defaults ultimately happen, which could be in states like New York, New Jersey, Florida, 3 or 4 years from now, that's when we'll start to see sort of like the losses associated with it. So what we don't know, is there going to be a resurgence of the virus? Well, if that happens, do states then shut back down again? Does that kind of set everything back? I see NOAA is calling for an active hurricane season this year. And, we've had a couple of named storms already. Well, what happens if one of these strikes? Well, the good news is we've been through this before several times. We've had the 3 storms in 2017. We had a couple of smaller storms throughout 2018, and very quiet, if I recall, 2019, predominantly with floods. But hurricanes are the big one because they tend to impact the most amount of people. It tends to hit that sort of eastern coast and into the Gulf, where we have a good population. So what does that do? Does that kind of kick things off? Again, with the end of the unemployment benefits in July, do we see a supplemental spike in August, September? How fast will the economy get back? If there's a vaccine, does that sort of accelerate where people start getting back to work? And how effective will our loss mitigation policies be? Like, we are putting in sort of new policies with FHFA and looking at how effective these policies might be is going to be very, very hard to do, as much like in hemp, when that was first rolled out, it had never been done before. And so that's a really interesting sort of idea of, well, what does that look like? And then, the big question is like, well, how many ultimately default from this? If people can get back to work and they get their jobs and everyone's sort of moving along, then, the concept of the payment deferral, which we have, is where you just bring people current and balloon the missed payments onto the end, but they are now gainfully employed at the same job or similar making. Well, then realistically, the defaults from this shouldn't be very high. There will, of course, be businesses that go under and don't come back. And the question is, well, how do you know which ones they are? Then there's obviously the other question, like, well, how many of these continue to extend? Right? Is it a 3-month, a 6-month, a 9, a 12? The CARES Act allows for up to 12 months of delinquency. And so this is a black swan event. These are things that we just don't know. And we look for anecdotal information. We talk to servicers. We work with service providers. We talk to the account management team. We talk to, anyone we can, just to get a feel for what they think, what they feel, and what they are getting talking to borrowers. And so then, like, just the final point I'll put on here is this concept that all past experiences that we have used to try and look at what might happen in the future may not be a good representation of what will happen in the future. And so what do I mean by that? What we saw throughout the 2017 sort of hurricane period was that it was a rapid event in a localized area that led to an increase in delinquencies, an increase in forbearances, but very little change in unemployment. I mean, there's maybe a spike of unemployment that came back relatively quickly, which meant it was a very transient affair. So people that went on forbearance that then came off after 2 or 3 months tended to stay current, really high performing rate. I mean, it was great. And those that even went on a bit longer forbearance that needed a modification to sort of come current also performed fairly well. So one would say, well, maybe that's a reasonable approach to what's happening now, except we didn't have this rapid and massive spike in unemployment and across the nation. Looking at that and then saying, well, should we use that as a path to educate future? And maybe, but then if you get into the concept of how servicers might be thinking about this, saying, well, the CARES Act allows for up to 6 months, and some servicers may have put a borrower on a 6-month forbearance straight up. Some may have put on a 3-month forbearance. And the question is there going to be a process by which servicers say rolling it out another 3 months is actually going to be okay? And so then you start moving into this process. And again, we don't know. These are just ideas and thoughts and sort of how we percolate on this stuff. are there these options where the process trumps a model-based approach? And so we don't know. And so this is all information we are trying to get much more detailed on, get much broader sort of focus on over the coming months. Now, again, making the assumption that the vast majority of people went on this that were current, which is what we had been told, that the vast majority of this stuff started in April, which is what we've seen in terms of the first round of delinquencies, that the 3 months ending, and again, assuming the majority went on a 3-month forbearance, the majority of this ends in the first quote spike ends in July. So then we should start to get, just based off of how our processes work, we start to get information about what happened in July in the first week of August. This is just a processing, this is how the system has been set up. We are looking at ways to get information sooner, but as we have it set up right now, this preliminary information is normally in by the first or by the third business day of the month following the month of activity. So again, first week of August, we should get a feel for what's happening in July.